Now let me talk about industry supply when we have one of either two cases. Either we have lots of identical firms, as before, but there are scarce or limited inputs for these firms, so that when we add more firms, we drive up input prices. So maybe we can go ahead and start lots more farms, but when we start lots more farms, that pushes up land prices or fertilizer prices or something like that. And then after that, we'll do the case of firms themselves have different cost structures. So these are actually two different cases, and they actually have kind of different end results here. The relatively easy case is, again, the firms themselves are identical, and what's going to happen here is that as we expand the number of firms, we're increasing their input price. So we could have, say, a short-run supply curve here with 100 firms. And what's going to happen here is we could think about the long-run industry average cost curve, or average total cost curve, might look like something like that. And here would be the short-run supply curve with 120 firms, and so on and so forth. And so when we combine all this information with a demand curve, we basically are coming to an explanation of why the supply curve is more elastic in the long run. So in this case, what we're saying here is this market would have a short-run equilibrium at the intersection of the short-run supply curve and the demand curve, but at that price, firms are earning economic profits because prices are above average total costs. So firms are going to enter the industry, and they're going to keep on entering the industry until prices match average total costs. So this short run curve is from marginal cost, the long run is from average total cost, and here we get our long run industry equilibrium. And notice, in both this case and in the constant cost with lots of identical firms, our long-run equilibrium features zero economic profit for the firms, because in all of these cases, price equals average total cost. So this is one of the things we see that is typical in highly competitive industries. In highly competitive industries, if there are economic profits being made, then firms enter and compete down prices, and eventually everyone is making a normal rate of profit, say 6 or 8 or 10% rate of profit on their invested capital, depending on the risk level of the industry and so on. It's also true that we don't see firms making really long-run persistent losses, because if there's a decline in demand, eventually firms will exit, and that will restore price to average total cost. This is going to look a little bit different when we have firms with different cost structures. So what's going to happen here is that instead of costs rising for all firms as we shift along this long-run average total cost curve, which is our long-run supply curve, what's happening is that we're adding less efficient firms to the market. So at this point here, we only have the most efficient firms existing in the market. So the ones with the lowest average total costs. If we want to get this large amount supplied, then we have to get firms into the market who are relatively inefficient and have relatively high average total costs. So at a high level of demand, we have lots of firms, both efficient and inefficient. At a low level of demand, only the most efficient firms can survive. Now, what you might say then is, well, if the price is high because there's a high level of demand, are these firms making these huge economic profits because they're getting a price which is way above their average total cost? And this is something where the answer is kind of subtle. Now, on one level, it looks like yes, but I'm going to try and persuade you that the answer is actually no. So let's go ahead and think about a real simple example where we have good land which produces, say, 100 units of Q, and we're not going to worry about firms adjusting their level of production. And we have for direct costs of $100. So sort of the seed and the labor and so on, it costs $100. And then we have bad land, which produces 100 units of Q for direct costs of, say, $500. It just takes a lot more labor and fertilizer and everything to grow stuff on this less fertile bad land. And let's suppose then the price of output equals $5. And you can see that this firm has, at a price of output of $5, this firm has direct costs per unit of $5. We had $500 of cost divided by $100. So how much profit does the bad land produce at a price of output of $5? Bad land profit equals 0. The good land profit is going to be, well, you had an average cost per unit of $1, and we produced 100 units, so it looks to me like the good land's profit is $400. But remember, we're interested in economic costs, not accounting costs. And these profits so far have been figured with just an accountant's conception of cost. So the question is, what is the opportunity cost of owning bad land rather than selling it, owning it rather than selling it, and what is the opportunity cost of selling good land? Well, we don't quite know yet, because we don't know the price of the good land and the bad land. If we did know, then we could think about the opportunity cost of capital, the opportunity cost of a capital asset, the fact that we're going to use this capital asset rather than selling it is the interest rate plus depreciation rate, but I'm not going to include that because this is land, times the market value of the asset. Because when I continue to use the asset rather than sell it, I'm passing up the opportunity to sell it for its market value. And if I did sell it for its market value, then I could take that money and invest it at whatever the interest rate is. Suppose the interest rate in our little toy example here is going to be 5%. We can actually use that to price the different types of land. And in particular, what price for the good land would lead farmers and potential farmers breaking even on selling versus not selling, because that would be an equilibrium price. So the idea here would be, well, let's take that $400 and divide by that interest rate. So $400 divided by 0.05, so that would be the same as $400 times 20, which would be $8,000. Because what happens here is if the good land sells for $8,000, then the $400 over the $8,000 gets us to a 5% rate of return. So there's an opportunity cost to farming the good land. In particular, the good land, if we farm it, we're giving up the opportunity to sell it for what its market price should be, $8,000, and then invest that money and earn $400 worth of interest, which would exactly cover the $400 worth of profit. So the key thing here is, one, we need to keep track of opportunity costs. Two, valuable assets have a high market value. And I know that may sound sort of circuitous, but it's worth remembering. So the key question, say for instance, would be something like, well, what's a better investment? A share in a monopoly company or a share in a small company? Well, what's going to happen here is the market prices of these companies are going to adjust to make the rates of return equal. So market prices of assets will adjust to keep rates of return or expected rates of return equal. So when we go back to it, going way back over here, and looking at our most efficient firms, these most efficient firms are valuable assets, or they own valuable assets. So they have a high opportunity cost to keep owning, because if we keep owning them, we're refusing to sell them and make a lot of money that way. These inefficient firms are not valuable assets. So we're not going to pass up very much by continuing to own them. So basically what we're saying here is that no, even a highly efficient firm doesn't earn economic profits in perfect competition, because their efficiency will become reflected or capitalized into the value of their assets, which will then raise their opportunity cost.